Good evening. For those of us who have spent the better part of 2 decades building a portfolio, we've grown accustomed to a certain type of noise. We watch the Federal Reserve's every move, we track the 10-year yield, and we debate the merits of cap rates in a shifting demographic landscape. This is the familiar terrain of the real estate investor. It is tangible. It is visible. But recently, a silent alarm has been triggered in a corridor most of us never bother to walk down. Bloomberg has reported that the FBI, alongside some of the world's largest financial institutions, is currently assessing a significant breach of a major real estate finance technology vendor. While the headlines focus on the hack, the deeper story, the one we are going to explore today, isn't about a temporary loss of data or a momentary disruption in service. This is about the integrity of the digital plumbing that underpins your equity. As an investor, your concern usually lies with the physical integrity of the building, the roof, the foundation, the tenant. But in 2024, the most critical vulnerability to your wealth isn't a leaking pipe in a basement in Chicago. It is a vulnerability in the software stack that bridges the gap between your bank and your deed. Today, we move beyond the sensationalism of cybercrime and enter a sober analysis of technical sustainability. This is the horizon. The Bloomberg report indicates that the FBI's investigation is focused on a vendor that serves as a critical node for banks. This isn't just a localized issue. When the FBI gets involved in a vendor breach, it suggests a systemic risk, a point where one failure can cascade through the entire financial ecosystem. For the investor over 40, this should feel different than the dot-com bubble or the 2008 crash. Those were failures of valuation and greed. This is a failure of infrastructure. We have entered an era where the soft parts of our assets, the digital records, the automated escrow processes, the technical custodial services, are becoming more fragile even as they become more essential. If you own property, you likely believe you own something solid. But the reality is that in the eyes of the global financial system, you own a set of digital entries in a database managed by a company you've likely never heard of. When that database is compromised, the very definition of ownership begins to blur. We aren't just talking about identity theft. We are talking about the potential for systemic corruption of the ledgers that prove your equity exists. Let's address the illusion of tangibility. Many of us were raised with the adage that land is the only thing they aren't making any more of. We like real estate because we can touch the bricks, walk the halls, and stand on the soil. It feels real in a way that a tech stock or a crypto asset does not. However, we must be intellectually honest. In the modern world, real estate has effectively become a digital derivative asset. Your physical access to a property is secondary to your digital record of title. If the plumbing, the software that manages these records, is compromised, your ability to leverage, sell, or even prove ownership of those bricks is paralyzed. We often assume that because the asset is physical, its security is physical. We buy better locks, we hire property managers, we vet our tenants. But we rarely, if ever, vet the technical custodians. We have built a multi-trillion-dollar industry on the assumption that the digital middleware, the software that sits between the bank's vault and the county recorder's office, is as solid as the concrete in our foundations. The recent FBI investigation into real estate tech vendors suggests that this assumption is not just flawed, it's dangerous. We are seeing a divergence between the perceived safety of bricks and mortar and the actual vulnerability of the digital records that represent them. To understand the anatomy of the breach, we have to look at the middle-tier software vendors. Most investors interact with a bank or a title company, but behind those household names is a web of specialized SaaS software as a service providers. These are the companies that handle loan servicing, escrow management, and automated title searches. They are the hidden pipes. The Bloomberg report highlights that these vendors are the target because they represent a single point of failure. Why would a sophisticated hacking group attempt to breach the fortified walls of JP Chase directly when they can target a third-party vendor that has a direct, trusted connection into JP Morgan's internal systems? By compromising a single middle-tier vendor, an actor can gain access to millions of records across hundreds of financial institutions. This is the force multiplier of modern cyber attacks. They aren't looking for one person's bank account. They are looking for the master key to the entire neighborhood's data. This allows for silent compromises, where data is not stolen for immediate ransom, but manipulated or monitored over years to facilitate large-scale equity fraud. When the FBI steps in, it's because the scale of the potential toxic spill in the data stream is too large for any one bank to manage. They are assessing whether the plumbing itself has been fundamentally poisoned. This brings us to what I call the legacy debt. The real estate industry, perhaps more than any other sector of finance, is notoriously slow to innovate. We are still using systems for title and escrow that were conceptualized in the 1970s and 80s, wrapped in a modern-looking web interface. This is what we call technical debt. It's the result of decades of choosing the cheapest, most convenient software solutions rather than the most secure ones. Because the real estate market has been so lucrative for so long, there was little incentive to tear out the walls and replace the aging digital infrastructure. If it worked, it was left alone. But that, if it ain't broke, don't fix it mentality has created a massive security vacuum. Sophisticated state actors and criminal syndicates have recognized that while banks have spent billions on cybersecurity, the companies the banks rely on to process property transactions have not. These vendors are often running on legacy code, managed by understaffed IT departments, and yet they hold the keys to billions of dollars in property equity. The breach reported by Bloomberg isn't a fluke. It is the inevitable outcome of an industry that has prioritized transaction speed over structural sustainability. We are now paying the interest on that legacy debt, and the currency is our collective security. As we watch this investigation unfold, it is important to maintain our composure. Panic is not an investment strategy. However, intellectual honesty requires us to acknowledge that the risk profile of real estate has fundamentally changed. We can no longer afford to be passive observers of the technology our assets sit upon. In the next part of our analysis, we will move from the what to the how. We will examine the domino effect this has on title insurance and escrow reliability, and I will provide you with a sober framework for how you, as an investor with a long-term horizon, should begin to audit the technical custodians of your wealth. We are moving toward a market where hardened digital assets will command a premium, and those left on vulnerable legacy systems will face a new kind of technical depreciation. The bricks aren't going anywhere, but the digital proof of who owns them is under siege. We need to ensure that your equity remains as solid as the ground it's built on. Stay with me. 5. Systemic contagion, the domino effect. When we read the Bloomberg report concerning the FBI and major banks investigating a breach of a real estate finance tech vendor, the instinct is to check our bank balances. But in the world of institutional finance and long-term equity, the balance is merely a reflection of a deeper, more complex ledger. We must talk about systemic contagion. In the real estate tech stack, no vendor is an island. A breach at a middle-tier finance vendor doesn't just expose data, it creates a crisis of provenance. Think of your property's equity as a chain. One link is your lender, another is the escrow company, a third is the title insurance provider, and a fourth is the county recorder's office. In the modern era, these links are no longer forged in steel. They are forged in code. If the vendor providing the plumbing, the software that facilitates the movement of funds or the verification of identity, is compromised, the integrity of the entire chain is called into question. Bloomberg highlights that the FBI's involvement suggests this isn't a localized smash and grab. It is an investigation into the infrastructure itself. For the investor over 40, the concern here is clouded title on a digital scale. If a sophisticated actor gains access to the systems that manage loan servicing or title transfers, they don't just steal money. They potentially inject noise into the legal proof of ownership. We saw a version of this during the 2008 robo-signing scandal, where the physical paperwork couldn't keep up with the digital speed of the market. Today, the risk is inverted. The digital records are being compromised, leaving the physical assets in a state of legal limbo. This contagion affects escrow reliability. Can you trust that the funds at closing are truly clear? And it forces title insurers to reassess their risk models. If the source of truth for property ownership is a vulnerable database, the very foundation of your digital equity is at risk of liquefaction. 6. Vetting the plumbing, a sober guide. As investors who have navigated market cycles, we know how to vet a property. We check the roof, the foundation, and the rent roll. But how many of us vet the technical custodians of our assets? If you are holding significant equity in REITs, private equity funds, or even direct commercial holdings, you are a silent partner in their cybersecurity posture. It is time to move from passive ownership to active technical oversight. When you sit down with your fund managers or lenders, the conversation needs to shift. We are no longer asking only about interest rates or occupancy. We must ask, who is the weakest link in your tech stack? Start with these questions. First, ask about vendor risk management. The Bloomberg report reminds us that it wasn't the banks themselves that were necessarily the entry point, but a third-party vendor. Does your investment firm audit the security of their software providers? Second, inquire about data provenance. If their systems were breached tomorrow, do they have a cold storage or immutable backup of the ownership records? For the 40-plus investor, this isn't about becoming a coder. It's about fiduciary responsibility. We must demand a technical annex in our quarterly reports. We need to see evidence of SOC 2 Type 2 compliance, yes, but we also need to hear a coherent strategy on how they handle zero-trust environments. If your manager looks at you with a blank stare when you ask about their digital plumbing, they are telling you everything you need to know about the long-term sustainability of that asset. In this era, a secure ledger is just as important as a balanced ledger. 7. The security premium, a market shift. Predicting the future of real estate requires us to look at how risk is priced. For decades, we priced risk based on location, tenant quality, and interest rates. I am suggesting that we are entering an era where a security premium will emerge. We will see a bifurcation in the market. Hardened digital assets versus those managed on vulnerable legacy systems. Think of it like green building certifications from 15 years ago. Initially, it was a niche interest. Eventually, it became a requirement for institutional capital. The same will happen with technical security. Institutional investors, spooked by investigations like the one Bloomberg is currently reporting on, will begin to demand a cyber discount for assets managed by firms with outdated infrastructure. Conversely, those who invest in hardened plumbing, those who use decentralized ledgers, multi-signature authentication for large transfers, and rigorous third-party auditing, will command a higher valuation. Why? Because their equity is durable. In a systemic hack, their records remain untainted. Their closings aren't delayed by FBI investigations into their vendors. For us, the opportunity lies in identifying these technically resilient assets early. We should be looking for firms that treat their IT budget not as an overhead expense, but as a core component of their risk management strategy. The peace of mind that comes from knowing your property's digital identity is secure is no longer a luxury. It is becoming a primary driver of alpha. 8. Conclusion. The horizon view. We must be intellectually honest with ourselves. The bricks and mortar of our portfolios are tangible, but the equity we've spent decades building is increasingly ethereal, residing in databases and transmitted through vendors we've never heard of until they appear in a Bloomberg headline. The FBI investigation into real estate finance tech isn't a reason to panic, but it is a clarion call to evolve. We are moving out of the era of blind trust in the financial system's plumbing. Long-term sustainability in the 21st century requires us to be as diligent about our digital deeds as we are about our physical property lines. At the horizon, we believe that the most successful investors of the next decade won't just be the ones with the most capital, but the ones with the most secure technical provenance. Your equity is a story told in data. Make sure that story is written on a foundation that cannot be erased by a single point of failure. As we keep our eyes on the shifting landscape, remember, the bricks aren't going anywhere, but it's our job to ensure the proof of ownership remains just as solid. Stay informed, stay analytical, and most importantly, stay diligent. I'm the Horizon. Until next time.